Hey man, if you're a business owner, especially if you have started a new business and you're in the growth stages, probably the first 1 or 2 years, then the number one thing you should stay away from is that bright, shiny object syndrome, which is also a very big scam, which is the passive income lobby. If you're a business person and you're building your business, you have only one asset class under your responsibility, and that asset class is your business. At this point in time, especially if you have been an ex corporate employee who has been dabbling into any kind of passive income, like probably mutual funds or real estate or something like that, your job is to get your mind out from those asset classes. It's easy to be a corporate employee and dabble in all of these different asset classes, and it is super difficult to concentrate your mind only on the one thing that's going to change the fortunes of you and your family, and that is your business. So at this point in time, if you're starting out a business and it's less than 2 years old, you need to get your head out of all of these different scams. And I call them scams because I'm going to walk you through how all of these different lobbies are scamming Indian middle class. And I want you to focus it on your business, because the number one thing that's going to change the trajectory of your life is your own business and nothing else. All of these other things are good when you do have the money, but in order to actually make the money, you need to have active income. So let's go into what are the different 5 laws of the passive income, of the passive income stream, and what is this lobby, and who are the people and players involved that are all hand in glove in getting money from the middle class and making sure that the middle class actually never sees the returns. All right, so I'll be going very deep into that. Let's go into the 5 laws on how to protect yourself from this passive income lobby scam. And make no mistake, it is a big scam. Let's go into the first law, the law of responsibility. Very, very simple, my friend. If you're in the marketplace, you're getting paid to take responsibility. Okay, there are only two ways to do this. You either work for somebody who takes responsibility, that means you're an employee, or you actually take somebody's responsibility on your own head, and that's where you become an entrepreneur. What is an entrepreneur really doing? Either people have pains that they want to get away from, they want to reduce pain in their life, or they have some pleasures or some goals that they want to bring closer to them. So you're cutting time and complexity out of having people achieve their goals. And those are the only two ways in which you basically take responsibility. You remove people's pains, or you accelerate people's pleasures, and you take the responsibility that you're the person that your clientele is going to trust for this, and for that you get paid. And this is what we call value in the marketplace. So in the marketplace, you're getting paid for value. What is value? To take responsibility. Okay, a lot of passive income lobbies are going to come and say, okay, if you put your money over here, we take the responsibility, but you can get the return. No, you're not going to get the return, and you do deserve to get screwed or scammed, because you did not take responsibility and you violated law number 1, which is you don't get paid unless you take responsibility. Very simple. Okay, let's go to number 2. The number 2 is that passive income is a myth created to take money from people who do not want to take responsibility and move it to the people who do want to take responsibility for somebody else's pain or pleasure or whatever it is. Okay, now I'm not saying arbitrarily that passive income as a concept is bad. No, of course, there is passive income is the only way by which you can become financially free or financially independent or wealthy after a certain amount of time. But what happens with Indian middle class people, especially the ones who are either in a job or just starting off in their new business and they haven't understood the game? What happens is they try to do everything all at once, and that's how they get scammed. Okay, there are 3 kinds of scams that happen with you, and if you look deep into your investments, chances are that these scams are happening with you. Before I made this video, by the way, I've spent 20 years investing into every possible one of these vehicles, which is stock market, which is mutual funds, which is residential real estate, you have commercial real estate, landed parcels, fractional ownership, business schemes, you name it, and I have done it. And the one thing I've realized is everybody is getting scammed in one of 3 areas. Either money that you're investing is getting locked or lost, so that you don't have access to that money when you need it. Second, when you do actually get some gains, you realize that so much time has passed or so much pain has been incurred on your behalf that the juice is not worth the squeeze. You realize, okay, finally I got my money back and something on top. But if you really do the math, the returns are not that great. Number 3, if the government realizes that there is some action going on in one particular sector, they're going to come in and they're going to start taxing the living daylights out of it, so that all the action actually starts flowing to the government. You actually never make any money. Okay. And that is the case with every single asset class. Now, definitely real estate and portfolio, which is your stock market, are two of the safest, best, or traditional asset classes. But if you see in India, the return on real estate is hardly anything. The risks are skyrocketed. And on the stock market stuff, the government has already started taxing it. So you've got even long-term capital gains tax and things like that. So the only place where your money is actually safe from getting bitten off by all of these different vultures and birds of prey that are eating into your corpus, and I'll be going into it in detail. The only real asset class that I feel is somewhere safe is basically index funds. Okay. And everybody, I feel, should have their investments parked in index funds. Definitely do your PPF. Just check with your chartered accountant. But if you're a business owner and if your business is less than 2 years old, I don't want you to use your brains into any of these asset classes. If you have a chartered accountant taking care of it, if you have your spouse taking care of it, let them take care of it. Your only goal should be to spend time in your business. Usually when you actually start building your business, that all of these different schemes, etc., they start appearing out of thin air. And what happens is that when you're building your business, to clear out or to really figure out that value equation really takes a lot of work in the first 2 years. And during this time, you pretty much get hijacked by all of these different shiny object syndromes, because they look easier than actually building your own business. And this is where the money gets lost, and more importantly, time and opportunity gets lost. So even if you are making a compounded annual growth rate of, let's say, 7%, 10%, 12%, 14%, or whatever it is, at the end of the day, it is not as good as making your business work 10x every 2 or 3 months. And in the first 2 years, you can actually double or triple the revenues of your business every 3 to 6 months at least. Okay. So do not get waylaid by all of these. And I'm going to come very, very hard on this, because yes, passive income, the passive income lobby is a scam top to bottom. All right. So let's go into rule number 3. What is the rule number 3? Is that the law of wealth says that the person closest to the money controls the money and actually makes the most money. That means the wealth moves through the active income channels first, and the passive income guys get paid the last. Okay, I'm going to be drawing a diagram for you later in this video, so just hold on. Very simple. Let's just quickly recap the law of responsibility. You get paid for taking responsibility. Any myth of passive income has been created to take money from people who don't want to take responsibility and move it to the active income people, the people who are actually taking responsibility. All right. Law of wealth says that those active income people are the closest to the money, and they control the money and they make the most money. They take most of the gains out of the table even before the actual passive income gains kick in for the ones who are waiting for them, and they are the ones who never took responsibility. All right. Next, we've got item number 4, law of experience. Law of experience, very important, my friend. You can only make passive income in the area that you have experience in making active income. That means if it's a business area where you yourself have a lot of experience, then you can make passive income from that particular business area. That also works out for derivatives. You see a lot of people who are doing option selling and stuff like that. I mean, these are flash in the pan kind of opportunities. A lot of people who are doing crypto and stuff like that. Listen, if somebody has made it their business to be in that market 24/7, 365 and play it for 2 years, 5 years, 10 years, then it, at the end of the day, it becomes an active income opportunity for them, and they are the ones who actually make the passive gains out of that opportunity as well. Only after losing their shirt at least once or twice. So the people who are extremely good in the marketplace, they have been playing that market for tens of 20s of years, and they have actually gone in and out. They've seen the rock bottom and they've come up from there. So now they can literally breathe the communication directly from the marketplace. All right. You can only make passive income in a market where you have actually made active income on. Let's talk about Warren Buffett. He's like the biggest investor in the world, and he makes a lot of passive income. But remember, Warren Buffett actually started by actually visiting companies that he was going to invest in, talking to the actual CEOs, to the different directors. And when he actually started investing some of his biggest trades, he not only invested passively, he actually got a board seat. He actually got voting rights in the company. He started controlling these companies so that the company would run as per how he wanted them to run. So he had a lot of say in actually the workings of the companies that he invests in. So he's not really a passive guy. He's a hardcore business guy, and he actually has the power to hire and fire the CEOs of the companies that he's investing in, and he makes sure that he gets that right by buying by buying voting rights on the board of directors. Okay, very very important. Okay, so for Warren Buffett, it is actually an active income play. Similarly, if you will see that the people who actually make passive income from real estate, etc., they have been involved in the real estate game at a very very close level, whether it's at the government level, whether it's at the brokering level, whether it's the builder level, politician level, and they are the ones who actually make the maximum gains out of these real estate markets, not just somebody who shows up and starts playing with their pocket money or something like that. Okay, so be very very careful. I don't want you to lose your money, because everybody over here loses money. Only very few people make money, which brings me to the ultimate law, the law of inversion, my friend, the law of inversion. When the market is going good, two types of people enter the market: the ones with the experience and the ones with the money. Okay, when the market is going good, two people will enter the market: the ones with the experience and the ones with the money. And in the correction or the downswing that happens, the ones who brought the experience take the money and leave, and the ones who brought the money are left with the experience. Yeah. And remember, if you are finding out that a market is hot, if you, my friend, are finding out that the market is hot, chances are that you're going to be the patsy. Okay, this happens every single time for years on years on years on years. And there are people in the marketplace I've seen every 2 years they find a new market and they believe it's the hot market. But chances are that by the time you're finding out it's the hot market, you're the one going to be the patsy who's going to be the one left with the experience. And I've seen people who, for the last 20 years, have left lost their shirt, their pant, their boots, their socks, and every time they feel surprised that why is it always me? As soon as I enter the market dries up. That's because with the level of information you're operating with, which is the lowest form of information, which is gossip information or the stuff that gets printed in the media, after all the gains have been skimmed away from the actual transaction, you're the one who's left with the experience, and your cash is taken away by the people who actually brought the experience to the table in the first place. Okay, so how do these markets really work? Let me just show you in one simple diagram how do these transactions actually occur. Transactions occur from people who actually have the ideas and who take the responsibility of taking an idea to the marketplace. All right, so what happens in a particular, let us say, real estate trade? Okay, you got a real estate property that's going out to the market and you are being targeted as the passive income investor. Please buy this apartment, put it on rent for 20 years and you will make passive income from this particular apartment. Now, before this apartment was built, land needed to be acquired and a politician came into play. Okay, when the politician helped the land to be acquired, then the builder came into play, and the builders and the banks actually paid off the landowner and the politician. And these are the guys who ended up with the property. So the bank and the builder now own the property. They are now going to brokers and channel partners. So brokers and channel partners who are going to find patsies like you and give them, basically you're just a consumer, you're no investor, you're just a consumer who's buying a consumable with money that they don't have and with knowledge that they're not going to get for the next 20 years. And you're going to be shown this dream that this is going to be an investment for you. A house is an investment. No, a house is not an investment. Real estate returns 2% return on investment. Come on, man. Anything in the world returns more than that. And by the way, if you're a business owner, you have no business to be investing in real estate. You're a business owner, please invest in your own business. Okay? And now you are the patsy who comes in, and you are the actual investor, so-called investor, who is handed the bag. And remember, this is how the money flows. So who gets paid the first? The landowner and the politician get paid the first. Then you got the builders and the banks who get paid the next. Who do they get paid by? The brokers and the channel partners make sure they catch hold of people like you, and they cash out the banks and the builders. And in between, every single one of these transactions is done on a government paper. So the government gets paid every single time. Okay, so the government gets paid every single time. And the next person who's actually fleecing you, I won't say directly, but they are all part of this big scam, is the government. Remember, if a builder takes your money and they do not give you the apartment on time, in not a single one of these cases has the government been able to force the builder to give you the apartment on time or liquidate the deal and give you the cash back on time. In many of these cases, the government has fined the builders crores of rupees and actually pocketed that money and never given it back to the investors. Okay, so the government is a very big player in this whole game. I'm not saying any of this stuff is illegal. It is designed so that you are the patsy and you're the person who brings the cash and exits with the experience. Okay. And this is how these deals are played. How does it work in the stock market? Let's talk about another asset class. Stock market. Let's go back to the same diagram. I'll draw another one for you over here. Now, in this particular diagram, what's going to happen is the asset class is a company. Okay. And over here, you have a founder, and the founder starts a company and he takes a seed fund, maybe from somebody close to him or something like that. So you got the founding partner and you got the seed fund player, and then you got other players which are called series A players, series B players. What these players do is they help the company to grow from, let us say, 0 to the first 3 months, 6 months, help it to survive for year number 1, and they get to, let's say, series A round or something like that. Okay. And then a series of these investors are going to actually toggle and joggle the company's stock, and they're going to get cashed out at every single level. Finally, you have somebody called an investment banking firm, which is like a bank who creates a portfolio out of this company and pushes it out into the stock market, where somebody like a patsy, like you and me, these are the people who are told that, hey man, you are the investor, you're getting in an amazing opportunity for this particular IPO for this company that has been doing extremely well. And then we are the ones who actually pump money into the game, and all of these other people cash out. Today, the Indian market, by the way, investment market is at a very low reputation, because these founders and early stage investors have actually siphoned away the money from the end stage investors, and these IPOs have tanked and these companies are worth nothing. Okay, just go over to ChatGPT. I just went over to ChatGPT and I did a simple query. You can run this query yourself. What percentage of Indian IPO in the stock market tanked within 2 years of launch? And it says around half of Indian IPOs end up underwater within 2 years of listing. Here's what the data shows. Main board IPOs, 48% trading below their issue price, 44% negative after 12 months. Large IPOs, 5,000 crore plus. These are the blue chips. These are the so-called blue chips. Average 2-year return is minus 14%. After 2 years is minus 14%. Is 2 years after listing. Now hang on a second. What is the most risky stage of a company's growth? The riskiest stage of a company's growth is infancy, which is from the time of founding to the next 1 to 2 years. The next riskiest stage for a company is from the 1 year to the 5 year mark. From the 1 year to the 5 year mark. So they were the most vulnerable and the weakest within the first year, and from year number 1 to year number 5. Now let's do another quick query. What is the average runtime duration or age of these companies from the date of founding to the listing date in the Indian stock market? Now, founding to listing, tech startups have done 14 years before they actually got listed. That means for 14 years, these early stage investors and founders actually plundered these companies of all the value and gave all the shell casings to the middle class people, calling them as the investors, while the company lost value after listing on the stock market. Very simple. There are other companies which are non-tech guys, and these itself have done at least 3 years before listing. And the IPO process itself takes roughly about 12 to 18 months. Therefore, outside of the tech startup space, most firms anyway have a runtime of 3 to 5 years. You can see over here. That means after these companies actually became quite strong, they passed through some of the most vulnerable stages. After that, they have actually gone to the stock market at a very strong position, and they have tanked. Why have they tanked? They have tanked because whoever is closest to the money takes all of the money off the table, leaving the other for patsies like you and me who bring money to the table and walk away with the experience. So the ones with the experience will walk away with the money, and the ones with the money will walk away with the experience. Do not put your money into scams like this, which are just geared in our country to take money away from you sooner or later. The only real asset class that I personally support, but I'm not your chartered accountant, the only asset class I feel is still relatively untouched, although the government has started taxing long-term capital gain at 10%, is index-linked funds, where the fund management fees is at its lowest. How do these funds operate? Let me just give you another quick insight into how do these funds operate. If a fund is anything but outside of an index linked, which means index linked funds just work on the index market prices, so there is no real management involved. You've got the fund managers and you've got the transactions and rebalancing, which means every single day that they use their brains on how to make this fund perform, that means every single day these people are getting paid, and every single transaction is getting charged as part of the fund's management fees. You almost never see it happening visibly, because all of the fees and everything is now, they've become very smart. They've started baking everything into the net asset value that you get the statement. Okay, so some of the fees are publicly declared, some of the fees are just baked into the net asset value. You almost never come to know. So just do your own chat GPT on this and you'll find lots of different complaints and lots of different insights are coming out into how these mutual funds are run, and you absolutely cannot trust what's happening. Okay, and when it comes to the government actually empowering the actual individuals, government is doing nothing. Government only wants to collect tax, and as long as the India story is growing, everybody is going to make money hand over fist, and you're going to lose money in areas that you don't know how to operate in, or you're going to probably make some money. It's going to make you feel good, but the point is you lost the boat. If the potential in the market was 25%, you will get only 13%. You'll be happy with that, but that's not what is going to make you rich or change the trajectory of your life. Okay, so let's go back to the 5 laws, and what I want you to do, why am I sharing with these 5 laws in such a vociferous fashion, is because I want you to put your brains in your business, and that's it. That's what Robert Kiyosaki said: mind your own business, and that is the only way to do it. And if you don't want to do it, then don't get into business. Especially if you're a solopreneur, you do not have access to probably a balanced brain of other co-founders. If you do not have access to a board of advisors or something like that, then you're really flying solo. No need to spread your brains in 20,000 different things. Your goal is to make sure that your baby wins, that your baby survives, that your business basically survives those first 2 years. And the more brains you try to hedge your bets by saying, okay, I want to safeguard myself by playing these other asset classes, guaranteed your business is going to go down, and all of these asset classes combined are not going to change the trajectory of your family's life, because there are much bigger players playing this game to get all of the gains off the table before you see even a scrap of anything useful. Okay, so once again, before I shut off this video, law of responsibility: you only get paid for taking responsibility. That means you will only get paid for the value you create in the marketplace by your own business. Second, passive income is a myth created to take money from people who don't want to take responsibility, which is lazy middle class people in India who truly don't want to take responsibility, and they still have these dreams of making passive income, and they deserve to get scammed, and they are getting scammed every single minute of every single day. Okay, and this money is moved to people who do want to take responsibility, which is the people who are running the active businesses. Next, the law of wealth: the person closest to the money will control the money. So if you have a residential property, broker is going to charge you every single transaction. Government is going to charge you every time you put a tenant or every time a tenant vacates. You're going to be paying left, right, and center for the upkeep of the property, for paying property taxes, for paying the utilities, for paying the brokers, and for paying the society fees, while the actual people who are running the real estate industry, which is the actual society boards, which is the actual government, which is the actual brokers, which is the actual builders, they are skimming value off the table while calling you the investor, and you make only 2% of your real estate investment. I already showed you what happens in the stock market. I already showed you all of these other players are making money left, right, and center, including fund managers, including the government, including the listing people like the investment bankers. Every one of them are making money at your cost, while you're getting to feel like you're the investor. Just get the feels and they get the money. All right. Law of experience: you can only make passive income in an area you have experience in making active income. So get smart at doing business, play the market. Probably you'll make some losses, there will be some risk, you will get rejection, you'll feel horrible about yourself, you will feel like a failure in your own business. But once all of that stage is past, you will realize that you have built something of yourself, and the number one product in your own business, my friend, is what you become through it, not the other product that you're selling inside the business. Okay, the number one product is who you become through it, and then you will be able to get into any one of these marketplaces and become a passive investor. Also, maybe you can be on the maybe you can buy a controlling stake in any new company or any new startup, just like how Warren Buffett is doing that. But that's because he has been running companies and hiring and firing CEOs and managing companies his entire life. That's how he makes passive income from an area that he knows how to make active income in. All right. And the next, very important, remember, my friend, remember, I see people every year, the same people losing money in different sectors, because the law of inversion works every single time. Two people enter the market, the ones with the experience, ones with the money. And when they exit, the ones who had the money actually got the experience, and the ones who came with experience ended up with the money. Okay. Don't be on the wrong side of this particular equation, and just protect yourself and control your urges. So that's my intention for you. If you liked any particular thing, please let me know in the comments. If you hated something that I said, please let me know in the comments. Let's have a discussion about it. And my only intention is to protect you. There is not a single one of these asset classes that I haven't dabbled on for years and years together and figured out exactly how much money they make. They don't make much money. The only thing that makes money is who you become through doing your own business. And that is why I'm your solopreneur business coach. I look forward to seeing you in the next video, my friend. Bye-bye.